Okay, let's dive into this. Maybe forget what you think you know about getting good with money.
Right.
Forget all the complex formulas, trying to time the market perfectly. What if doing well with money has almost nothing to do with how smart you are?
And everything to do with something much harder.
Yeah, your behavior, how you actually act.
It sounds, well, kind of backwards, doesn't it?
Yeah.
But you see these stories, like the super wealthy executive, tons of cash, right? And he throws 5 grand at a hotel manager because he broke a $500 lamp.
Crazy. And that guy went broke eventually.
He did. Then you contrast that with someone like Ronald Reed,
The
the
janitor.
janitor, yeah, and gas station attendant. Lived super simply, invested his money quietly, consistently, and when he died, a multimillionaire.
Mm.
Left it all to charity.
Wow. No fancy degree, no secret sauce, just consistent rational behavior for a long, long time.
That's the core of it, really. And that contrast is what we're digging into today. We're pulling out the key ideas from Morgan Housel's book, The Psychology of Money.
It's a great book.
Fantastic. And our mission here is to, cut through the usual financial jargon, grab the most important lessons, and help you understand these powerful psychological forces, the ones often hidden, that really shape how we deal with money.
Because knowing what you should do, well, that's not enough, is it? Not if your own behavior trips you up.
Exactly. And the place to start understanding that behavior, it's realizing that your own unique personal history shapes almost everything.
Everything.
Think about it. Everyone you know, everyone listening, you've all had totally different experiences with money. If you grew up poor during a recession, your feeling about financial risk is just fundamentally different from someone who grew up wealthy during a boom.
Okay, that makes sense. Or like someone who remembers the crazy high inflation in the 70s. They're going to see interest rates differently than someone who only knows the low rates we've had for, the last decade or two?
Absolutely.
Yeah.
Or think geographically. Someone in Australia, they haven't seen a recession in like 30 years. Compare that to someone in the U.S. who's seen several downturns. These aren't just, different data points. They bake into your core beliefs about how money works.
They really do. The source mentions a study, right? Momendio and Nagel.
Yeah, finding that people's willingness to take financial risks, it isn't really about intelligence or education. It's mostly driven by the economy they experienced when they were becoming adults.
So your personal history, that tiny slice of world events you live through, becomes your lens for everything money-related.
It really does. Your assumptions about crashes, debt, investing, it all comes from that maybe 0.0000001% of world history you personally saw.
Which explains why smart people can look at the same charts, the same data, and just completely disagree on what to do next.
Precisely. And that leads to this really crucial idea in the book. Nobody is crazy.
Nobody is crazy. What does that mean exactly?
It means when you see someone making a money decision that looks totally bonkers to you, like the example used is low-income families spending maybe more on lottery tickets than on movies or books.
Yeah, I remember reading that. It sounds baffling, right? Especially when maybe they couldn't cover a small emergency expense.
From our outside view, maybe it seems irrational. But Housel argues that from their viewpoint, shaped by their life, their daily realities, maybe limited options,
Oh,
that lottery ticket isn't just a bad statistical bet.
it's something else.
It's paying for hope, a
Yeah.
tangible dream, maybe the only chance they feel they have to glimpse a totally different life. So in their context, with their story, the decision makes a certain kind of sense. Every decision makes sense to the person making it at that moment.
Huh. That's a really powerful way to think about it. Shifts your perspective from judgment to understanding. Okay, so beyond our own history, what else is going on unseen?
Well, the book really highlights luck and risk, calls them siblings. These massive forces outside our personal effort or skill, but they hugely impact outcomes.
And they're tricky because they're hard to see, hard to measure.
Exactly. Which makes them uncomfortable, right? It feels, I don't know, maybe jealous to say someone's success was partly luck.
Yeah, and it's demoralizing to think your failure wasn't just bad choices, but maybe just bad luck, being on the wrong side of risk, even if you made a good bet.
The book uses the Bill Gates and Ken Evans story, both brilliant, driven kids, partners, huge potential. But Kent died unexpectedly before Microsoft really took off. Same input, wildly different outcome. Housel calls it life roulette.
Wow.
So failure isn't always making a dumb move. Often it's just that the probabilities, which were less than 100%, didn't break your way this time.
The line between bold and reckless is thinner than we think then. Until afterwards, anyway.
So thin. Think about Cornelius Vanderbilt breaking rules and succeeding, or Benjamin Graham getting rich off Geico by breaking his own diversification rules.
Mm.
Ignore luck and risk, and you only see that line in hindsight.
Right. You only know if it was bold or reckless after you see the result.
Which leads to this core idea. Nothing is as good or as bad as it seems. Extreme success often has luck involved. Extreme failure often involves risk. You aren't invincible when you win, and you aren't necessarily incompetent when you lose. You need to expect bumps.
Which seems like a good transition to something that trips up even the super rich. The whole idea of more, greed, and that endless trap of comparing yourself to others.
Oh, yeah. There's that great story, Kurt Vonnegut and Joseph Heller at a party thrown by some billionaire hedge fund guy.
I love this one.
Vonnegut points out, hey, that guy made more money yesterday than you probably made from Catch 22 ever. And Heller just nails it, he says.
Yes, but I have something he will never have.
Enough.
Enough. It's so simple, but so hard.
It really is. Look at Rajat Gupta, CEO of McKinsey, worth $100 million.
Yeah.
A fortune.
More than enough, you'd think.
Right, but he wanted more. He wanted that billionaire circle. So he risked literally everything he had and needed his freedom, reputation for money he didn't have and didn't need. Insider trading.
Yeah.
Ended up in prison.
It's just foolish. It's like that Warren Buffett quote about long-term capital management.
Exactly. To make money they didn't have and didn't need, they risked what they did have and did need. It's the definition of foolish. Because that social comparison game, the ceiling just keeps going up forever. There's always someone richer.
You can't win that game.
You can't. Unless you just decide not to play. That's the only way.
And the funny thing is, all that stuff you buy to show off, the fancy car, whatever, the book says people don't usually admire you. They just use your stuff as a new benchmark for their own desires. Like, oh, they have that. Maybe I should get one too.
It's so true. Real wealth, like Ronald Read had, is often invisible. It's the money you don't spend, the savings, the investments quietly growing.
Which connects perfectly to the power of time, doesn't it?
Yeah.
And how compounding works in ways that just don't feel natural to our brains.
Not at all. Compounding is basically just multiplication over time, but we tend to think much more linearly, like addition.
Like the Ice Age analogy in the book.
Yeah, you don't need some massive blizzard every year. Just a little bit of snow sticking around, not melting, building up year after year after year. Eventually you get giant ice sheets. It's slow, gradual, then suddenly huge.
And in finance, the biggest force isn't genius stock picks, necessarily.
It's time. Time in the market. Look at Warren Buffett, obviously a brilliant investor, but his real superpower, being a pretty good investor for an incredibly long time, like decades and decades.
Compared to someone like Jim Simons, maybe. Higher returns per year.
Much higher. But Simon started later, so less total wealth accumulated despite those amazing returns. Time is that secret ingredient, the multiplier that just keeps working silently in the background.
Yeah.
We underestimate it constantly because it's not dramatic.
It's not sudden. It sneaks up on you. 2 + 2 + 2 is easy to grasp. 2 by 2 by 2, that gets big fast.
Exactly. Feels like nothing's happening for ages, and suddenly, wow, exponential growth.
And knowing this leads to maybe the most important single word in the whole book for financial success.
Survival.
Just survive. Stay in the game.
That's it. Getting rich and staying rich are two totally different skills.
Like those stories from the 1929 crash. Jesse Livermore, Abraham Germansky.
Yeah, both were amazing at making money, even initially profiting from the crash itself. Masters of accumulation, but they couldn't hold on to it. Livermore got overconfident, took too much risk, lost it all, tragically took his own life. Germansky just vanished after being wiped out.
So getting money needs risk, optimism, maybe being bold, but keeping it.
That requires the opposite sometimes. Humility, fear even, planning for things to inevitably go wrong.
Like Sequoia Capital, the venture capital firm, their secret wasn't just picking winners.
Right. Michael Moritz said it was their constant fear of going out of business. That paranoia kept them careful enough to survive the downturns that killed other firms. Longevity is the ultimate edge.
So survival means having that room for error, margin of safety. It's not about being timid.
No, it's about resilience. It's about increasing your odds of sticking around long enough to benefit from the long term. Like a card counter needs a big enough bankroll to ride out the losing streaks, you need that buffer to handle the market's inevitable dips and stay invested.
You have to plan on your plan not going according to plan.
That's probably the most vital part of any financial plan, because if you get wiped out, you lose all the future benefits of compounding. And that's why leverage too much debt is so incredibly risky.
Because it magnifies losses just as much as gains.
Turns everyday market swings into potential catastrophes. Rational optimism makes you think it won't happen to you. But when that downside risk hits with leverage, it doesn't just hurt, it can knock you out of the game for good.
Okay, so survival is crucial. Volatility is unavoidable. How do we deal with it mentally? The book talks about the price of admission, which I found really helpful.
Yeah, it reframes the whole thing. Success, especially in investing, isn't free. There's a cost you have to pay.
And it's not just fees or commissions.
No, the real price is paid in things like volatility, fear, doubt, uncertainty, regret, even. You look at the long-term chart of the S&P 500, it's amazing growth. But zoom in, it's a roller coaster.
Constant ups and downs. The source mentions even massive winners like Netflix or Monster Beverage spent most of their time trading below their previous highs.
Exactly. Those dips, that gut-wrenching uncertainty when things are down, that's the price you pay for the potential long-term return.
So you have to see it as a fee, not a fine.
Precisely. A fee is something you willingly pay for a service, for the potential gain. A fine is a punishment you try to avoid. If you try to avoid the fee of volatility, you usually end up missing the games. Or worse, making panicked mistakes that cost you even more.
Like GE trying to smooth earnings or Fannie and Freddie trying to eliminate risk.
It backfires. Try to avoid the fee often means you end up paying double later on.
Yeah.
You have to convince yourself deep down that the fee is worth it. That's how you endure the ride.
And part of enduring it is knowing what game you're actually playing.
Yes. It's easy to look at market bubbles, for instance, and just call everyone involved irrational.
Like the dot-com bubble.
Right. But were those day traders really irrational? Maybe not, if their game was short-term momentum. They were playing that game, and it worked. Until it didn't. They weren't necessarily playing the long-term investing game.
And this applies to spending too, right? Keeping up with the Joneses.
Totally. You see the lawyer with the fancy suit, the startup founder with the sports car. You feel pressure, but you don't know their game. Maybe the lawyer needs that suit for court appearances. If you're a freelance writer working from home and try to match their spending, you're playing their game by your rules. It doesn't fit.
So you need to figure out your own financial mission. What's money for in your life? Security, freedom, buying time. Knowing that helps you define your game.
Absolutely. Okay, let's shift slightly. Let's talk about pessimism versus optimism. It's everywhere in finance news.
And pessimism always sounds smarter, doesn't it?
It really does. As Deirdre McCloskey said, people like to hear that the world is going to hell. Doom sells. It's captivating.
Remember that Russian professor predicting the U.S. would break apart? Gets headlines. Slow, steady progress. Not so much.
But real optimism, Housel argues, isn't blind faith that everything will be great. It's more like a belief that over the long haul, the odds favor a good outcome, even with bumps along the way, because most people generally try to make things better.
So why is pessimism so sticky?
Well, money problems feel universal, personal. Bad news hits close to home. And financial media often focuses on immediate threats, potential disasters. Progress, on the other hand, is usually slow, incremental, almost invisible day to day.
Like the huge drop in heart disease deaths over decades saved millions of lives, but it happened gradually.
Exactly. While setbacks, a market crash, a company going bankrupt, are sudden, dramatic, attention-grabbing. We're wired to notice the threats, the sudden changes.
Like Hans Rosling said, everyone thinks the world is scarier than it really is.
Yeah. And maybe the ironic thing is, expecting setbacks, knowing things won't be smooth sailing, can actually make you more resilient. It sets realistic expectations, so you're less likely to panic when bumps do occur.
All these ideas, our biases, our reactions, they're all tied up in the power of stories, aren't they?
Hugely powerful. Narratives drive economies. The 2008 crisis wasn't just about bad loans. It was a crisis of confidence, a damaging narrative that froze everything.
And stories explain why we fall for things that look bad in hindsight, like Bernie Madoff's Ponzi scheme.
Right. When stakes are high and you feel like you don't have enough information, you get desperate. You become willing to believe a compelling story, even if it sounds too good to be true. Like medieval medicine, you try anything when you're desperate.
Even history itself isn't pure fact. It's shaped by the narratives we choose to tell.
Absolutely. Liddell Hart's point. There's too much data, so we filter it, select what fits our beliefs. We see the world through stories.
And Kahneman pointed out our bias in planning. Focus on our skill, ignore luck and competitors, focus on what we know, ignore the vast amount we don't.
We're like that alien orbiting Earth, seeing actions but totally missing the internal thoughts, the stories driving people.
So history is a guide, but definitely not a map for the future?
You got it. Relying only on past patterns is dangerous because the world changes. Innovation happens. Dynamics shift. That's why Graham himself kept updating his methods.
People laugh at it's different this time, but sometimes it actually is.
Right. As Michael Batnick joked, the most dangerous words might be warning about the other dangerous words. The world is always evolving.
And the only sure forecast?
Surprises will happen. Kahneman's insight again. The lesson from surprises isn't just that you are wrong, it's that the world itself is fundamentally surprising. Things will keep happening that move the needle unexpectedly.
Okay, that's a lot to digest. Let's try to boil down some key actionable takeaways from the book. First, respect luck and risk.
Yeah, focus on what you can control. Your savings, your effort, your humility, not the wild outcomes. And be careful who you idolize. Was their success skill? Or maybe just outlier luck?
Second, less ego, more wealth.
Wealth isn't what you spend, it's what you don't spend. It's saving today to buy options tomorrow. Keep that gap between income and ego wide.
Third, be okay with stuff going wrong.
Lots of individual bets will fail. That's normal. Judge your overall strategy, your whole portfolio's performance over time, not every single decision. You can be wrong half the time and still win big if you survive long enough for the winners to really run.
Fourth, use money to buy control over your time.
Maybe the best thing money can buy. Doing what you want, when you want, with who you want, for as long as you want. That autonomy is priceless for happiness.
Fifth, be nicer, less flashy.
People respect kindness and humility more than stuff. Trying to impress with possessions often backfires or just makes others want more stuff too.
Sixth, just save, period.
Save without needing a specific goal for every dollar. That buffer, that cushion, protects you against life's inevitable curveballs. It buys you flexibility.
7. Define the cost. Pay the price.
Except that volatility, fear, doubt, those are the fees for playing the game, the price of admission for potential long-term gains. Don't treat them like fines to be dodged.
8. Worship room for error.
That margin of safety is your lifeline.
Yeah.
It gives you endurance. It lets compounding work. Plan for failure. Avoid excessive debt like the plague.
9, avoid extreme plans.
Your goals will change. You'll change. That's the end of history illusion. Extreme financial paths, crazy frugality, working yourself to death lock you in and often lead to regret later when you realize you sacrificed too much. And finally, 10. Good decisions aren't always purely rational. Sometimes reasonable is better.
Like keeping extra cash or paying off the mortgage early.
Exactly. Might not optimize every cent on a spreadsheet, but if it helps you sleep at night, stick to your core plan and avoid panicked mistakes during tough times. That peace of mind, that behavioral insurance is incredibly valuable. It helps you stay the course.
You know, thinking about all this, especially that historical bit the book touches on, post-World War II, you had low rates, rising incomes, everyone kind of moving up together.
Right, it set this expectation, didn't it? A broadly shared middle-class dream, constantly improving.
But then things shifted, maybe in the 70s, 80s. Growth got really uneven. Top incomes soared. Median incomes kind of stalled.
But that expectation didn't stall. It persisted. People still felt they should be achieving that same upward trajectory their parents maybe did.
Leading to the big stretch, as Housel calls it. People using more debt, bigger mortgages, more car loans, student debt, just to try and keep up appearances, to maintain a lifestyle that was harder to afford on the median income.
Yeah, houses got bigger, debt loads got bigger, all driven by that gap between expectation and reality, plus that relentless social comparison.
That history just hammers home how much our money behavior is tied to the times we live in, the experiences we have. It's not just logic.
Not at all. It's psychology, history, human quirks, emotions, all mixed together. Understanding the psychology of money isn't about finding a magic formula.
It's about understanding ourselves.
And the world around us, yeah. Recognizing these powerful, often irrational forces within us and out there. It's about trying to make choices that actually fit your life, your definition of enough, not chasing some abstract rationality or someone else's dreams.
So if we leave you listening with one final thought to chew on, maybe it's that Kahneman point about surprises. The world is surprising. History guides, but it's not a map. How is your own unique history, your upbringing, your wins, your losses, your fear, shaping how you see money right now? And maybe more importantly, what game are you truly playing? Worth thinking about.